In this video, we are going to tackle some of the most common myths about investing. There's a lot of misinformation out there that can hold people back from getting started or lead them in the wrong way. I want to clear up some of those misconceptions so you can invest with confidence. And if you're somebody who hasn't started investing, this video might give you the push you require. Let's begin. Before we begin, I just want to say that nothing in this video is financial advice. Everybody's money situation and financial goals are different, so they must take their own decision. What I want to do in this video is to make sure that you don't fall for stupid investing beliefs. Having said that, let's get to myth number 1, that is, you need a lot of money to start investing. This is simply not true. You can start investing with very little amounts. You can even start investing with just $1. The reason this point is so important is because there's a lot of people who are falling for this trap that I'll invest when I have enough money. Even I have fallen for this trap in my early 20s, and I'm sure you must have fallen for it at some point, or you have seen other people do it. The most important thing in investing is actually getting started, not getting started with a large sum of money. In fact, the key to successful investing is to contribute small amounts of money over a long period of time. This is why the concept of dollar cost averaging is so popular. You can set a schedule and invest small amounts of money over a long period of time. I'm always surprised to find out that people don't know that you can actually get started investing with just $1. Most brokerages nowadays actually have no minimum requirements when it comes to buying stocks. It's quite easy to understand why people feel this way. You see Amazon trading at $200 and you think there's no way I can afford to buy one Amazon stock. But the truth is that you don't need to. A lot of these brokerages also offer fractional trading. That means you can own 0.1 of a stock. Looking at this example, if you were to invest $200 into the S&P 500 over the course of your lifetime, it's quite probable that you can retire with over $1 million in your account. Again, the most important thing is to get started, whether it's with $1, $100 or $1,000. You should not wait to have enough money to start investing. Speaking about having enough before investing brings us to the next myth, which is quite closely related. That is, investing is only for the wealthy. Again, this is absolutely not true. Anybody can start investing to grow their wealth over a period of time. The reason this myth exists is because rich people come from families and backgrounds where investing is discussed a lot, while there are other parts of society where money and investing is not discussed at all and is seen as a taboo topic. So a lot of people grow up with the mindset that investing is for rich people, and if they come from lower or middle class, they should not even think about it, and that's completely wrong. There are even people who think that you need more money because you might have to pay fees to your advisors or money managers, but that's not true. There are lots of low cost options available nowadays. You can invest in index funds or ETFs, which makes it easy for anyone to get started. These ETFs actually have very low management fees. One of the most popular ones in the US is VOO, which tracks the S&P 500. In Canada, we have something similar called the VFV. I actually find this belief to be quite funny and even paradoxical, because there are people out there who believe that they should be wealthy to start investing, whereas investing is one way to actually become wealthy in the first place. You should remember, your current wealth doesn't determine your ability to invest. You have just as much right to participate as anybody else, no matter how much money they have. In fact, I would argue that starting from a modest position of wealth is actually good for you, because you get to learn the value of money throughout your investing journey as well. Talking about what it really takes to start investing, let's look at the next myth, that is, you need to be a math whiz to start investing. This one is again not true. We all know people who say things like, I'm not good with money and investing because I'm not really good at math. While investing does require you to understand some numbers, math is definitely not a requirement for investing. In fact, I would argue that apart from a few numbers such as revenue, profit margins, price to earnings ratio, price to sales ratio, and growth rate, you don't really need a lot of numbers to start investing. What you really need is to understand how to do fundamental analysis, which involves understanding what the company does and if they are doing well. It's the second part where you need to understand if they are doing well that you'll need a few numbers. In fact, nowadays there's plenty of tools that will give you all the numbers you require and you don't need to do anything as people used to do back in the day. In fact, for most people, none of this matters. Most people out there are investing in ETFs and index funds. The best thing is that these are self-adjusting and you don't need to do anything apart from dollar cost average and make sure you're investing with discipline. The most important thing is to educate yourself with simple things such as why investing matters and not get bogged down in complex analysis. Successful investing is all about discipline and emotional control rather than advanced math. By the way, if you're enjoying the video so far, hit like and consider subscribing. Comment below at what age did you start investing? As you might imagine, a lot of people are investing. They're investing for their retirement through their banks or even through their companies. This actually brings us to the next myth, that is, investing is only for retirement. This is a very common misconception. A lot of people out there think that investing is just for retirement reasons. While investing for retirement is crucial, that is not the only reason you should be investing. Investing can actually help you reach various financial goals, whether that's buying a house, funding your education, or even starting a business at some point. If nothing else, investing will help you grow your wealth over a period of time, not just in your retirement account, but in your other accounts as well. But if you think about investing just from a retirement point of view, you're going to leave a lot of money on the table and not utilize all the other accounts that might be available to you. For example, here in Canada, we have our retirement savings accounts, but we also have tax-free savings account where we can grow our wealth without being taxed. We also have our first home savings account where we can invest to buy our first house. If I were to think about investing just from a retirement point of view, I would not be using all these accounts, which would be a huge mistake. The key is to match your investment strategy to your timeline. Invest differently for short-term goals versus long-term goals. The one thing to remind yourself about investing for retirement is that the earlier you start investing, the more money you will have in your older years, all thanks to compounding. Speaking of time, let's address another common belief, that is, timing the market is the key to success. Even though the saying time in the market beats timing the market is so popular, there are lots of people out there who still believe that they need to time the market. Even a lot of experienced investors are still trying to time the market in some or the other form. I would say that timing is very important when it comes to trading, but not so important when it comes to investing. When it comes to investing, what matters more is discipline and consistency. Many people think that the secret to successful investing is buying at the perfect time and selling at the peak. If only it were that easy. As somebody who's tried to time the market a lot in the past, I can tell you it's very difficult. You need to learn a lot of technical analysis to actually start timing the market, and even then you'll fail multiple times. The reality is that even professional traders struggle to time the market. It's very hard to predict the market in the short term. What you should do is focus on building a diversified portfolio and staying invested through the ups and downs. This is much more likely to lead to success over time. There are people and funds out there who have an army of analysts who are sitting and trying to predict the market. Do you really think you can beat them at their own game? Maybe you can, but it's gonna take a long time for you to truly understand if you're good at it or not. Again, if you're jumping in and out of the market, you're basically trading and not investing. And when it comes to trading, emotions are very hard to fight in the first place. Tops are always hard to predict, and fear is extreme at the bottoms, which makes it very difficult to buy. Trying to fight all these emotions around investing and trying to fight smart money is likely not going to give you good results over a long period of time. This actually brings us to another myth, that is, you should sell everything when the market drops. This one is actually very closely related to the previous one. Often when the market drops by a lot, there's a lot of panic in the market and you have this urge to sell out of your assets. Now, whether it's to protect your capital or whether you're trying to time the market and trying to buy back lower, it's probably not a good move. History has shown that market goes through cycles. Downturns are normal and to be expected, but over the long term, the market has always recovered and reached new highs. People who sell in a downturn are most likely to miss out the rebound because it's so hard to predict when the rebound is going to come. Instead, have a plan in place before a downturn happens. Know that they are a normal part of investing and be prepared to ride them out. The stupidest thing you can do is think that the market goes up in a straight line. That never happens. You have to get used to the ebbs and flows of the market. You have to stay invested through the downturns and make sure you also have some cash set aside in case good opportunities come along for you to invest. A good example of this was March 2020 when so many people were panic selling. However, if you were to buy at that time or just hold on to your investments, you would have made so much money. Now, all of this is good and holding your assets through downturns is also good, but you should ensure that you're holding quality assets. If you're holding ETFs, then it doesn't really matter, but if you're holding individual companies or alternative assets, you should make sure that they are of good quality. Talking about this actually brings us to the next myth, that is, you should always buy the cheapest stocks. It's a weird phenomenon but a common misunderstanding where people seek out stocks which are lower priced because they somehow think of it as a better deal. The price of the stock actually has nothing to do with the value of the company, and you should not focus on just the price and look at a lot more things. A $10 stock can be a worse investment than a $100 stock if the underlying company is in trouble or overvalued. What matters is the value you're getting for the price you're paying. What matters is the company's fundamentals, its potential for growth, and many other factors. Rather than just looking at the price tag, it's important to research the actual business, evaluate its financial health, competitive position, and growth prospects. Also, definitely get out of the mentality of what if I pay $10 for this stock and it reaches $100. Based on what? You need to really understand what you're trying to do here. You shouldn't just aim on multiples because some other company went from $10 to $100. You need to understand where the company is at and can it really reach what you're aiming for based on other numbers that the company is projecting. On a related note, let's discuss a very dangerous assumption and the next belief, that is a stock that has fallen is bound to rebound. So let me start this one with a personal painful story. I was working at this company and some stocks were allocated to me at $100. I did not sell them because once they were allocated to me, the price dropped to $80. I was under the impression that it's going to rebound back to $100 because I was not really looking at the fundamentals. Next thing you know, it had actually dropped to $60. And as of today, it's sitting at just $3. And I'm not sitting here waiting for a rebound because now I truly understand how things work. Just because the stock has dropped by X% does not mean that it's going to bounce back to its old prices. Especially not if fundamentally something has changed with the company and the market is just not seeing any value in the company anymore. The drop in price could reflect serious underlying problems with the business, changes in its industry, or negative developments. On the other hand, trying to buy a stock which has fallen a lot hoping for a rebound is actually known as trying to catch a falling knife. It's a very risky move. If you hold an asset or a company that's falling by a lot, it's truly important to understand why it's falling. Something might have fundamentally changed with the company and you might want to reevaluate your investment thesis. You might want to reallocate or completely get out of the stock when there's still time. I believe this is a lesson a lot of people learn by going through painful experiences. But if you can avoid such a problem, please try to avoid it. Focus on good companies and do not play with companies that don't have any fundamental value. Keep an eye on your individual investments and be brave to cut your losses when the time comes. Investing is not always about winning, it's about winning overall. And as they say, hope is not a strategy, so don't sit there hoping for a rebound in the future when you're holding a company that actually has fundamentally changed. Talking about the future brings us to the next belief, that is past performance predicts future results. It's a very common thing where people look at the past performance of a stock and try to predict what will happen next for the same stock. While patterns can repeat in the short term, in the long term what again matters is the fundamental value creation that is done by the company. There are a lot of people out there who look at the performance of a stock in the past and hope that the trend continues in the future. While the trend can continue again, it doesn't mean it has to. It really depends on the fundamentals of the company and where the company is going. It's one thing for a company to go from 1 billion market cap to 10 billion market cap, but reaching 100 billion 1 trillion is almost impossible for most companies out there. So just because the stock has done a 10x before, don't expect it to do it again. It has to be an extremely strong business to pull off something like that again. You must have all seen the famous disclaimer that says past performance is no guarantee of future results. There's a reason why you see this so often, because nothing in the future is guaranteed. While studying the past is extremely important and can provide valuable insight, it does not predict the future. Remember, history doesn't repeat, but it often rhymes. An example of this is actually the 18.6-year real estate cycle. This shows that real estate has an average cycle of 18.6 years. After every around 18.6 years, the real estate goes through a turbulent time. The last one we saw was in 2008, and it doesn't mean that in 2026 we should all be sitting here waiting for a real estate cycle. It does not work like that. If everybody is expecting something, it's most likely not going to happen. And that is why we have it as an average of 18.6 years. So as we approach that, you should be a little more cautious and keep an eye on the market. However, it doesn't mean it's going to happen exactly when you're expecting it. Past performance is no guarantee of future results also applies to individual companies. Even a company with a stellar track record can face new challenges, increased competition, or shifts in its industry that changes its prospects completely. What you need to do is always keep an eye on the future and change your strategies if something drastically changes in the markets. However, the best strategy, as we have discussed throughout this video, is to stay disciplined and invest consistently using a dollar cost averaging method. The next thing on our list is a belief that really enrages me, that is the media gives you all the information you need. So I'm not going to spend a lot of time on this one because I recently made a full video talking about how mainstream media is keeping investors poor. I would highly encourage you to go watch that video. If I had to summarize, I would say that media coverage often focuses on short-term events, sensational stories, and market fluctuations. This basically creates a lot of noise that is not necessary and relevant to your long-term investment strategy. There are three things that you must remember when it comes to mainstream media. Firstly, they're in the business of selling news. Secondly, they're extremely biased and mostly useless. And thirdly, they're not there to make you money. In fact, they're there to make themselves money. Having said all that, I don't want you to completely stop watching mainstream media either. Just be extremely picky in what you watch and when you watch it. Always do your own research, consult multiple sources, and think for yourself. Your financial goals and risk tolerance are unique. We are almost done, but I want to make sure that I address the most dangerous myth of all, that is, investing is a quick way to get rich. We have all heard stories of people suddenly getting rich in the stock market. In fact, there are people out there who have made millions of dollars in a very short amount of time. We often hear about success stories because of something known as survivorship bias, something that I also covered in this video. It is important to know that for most people, investing is not a get rich quick scheme. Real and sustainable wealth is built slowly through consistent investing, patience, and discipline. There are no real and reliable shortcuts when it comes to investing. When it does happen to people, it's by a stroke of luck. Nowadays, especially in the world of social media, you often see these secret formula or a sure thing that you come across. Be extremely wary of those. Again, for most people, for people like you and me, the best strategy is to have a diversified portfolio of different assets that can sustain wealth growth over a long period of time. So there you have it. We have debunked some of the most common beliefs and myths about investing that you should definitely stay away from. By avoiding these and sticking to time-tested principles, you too can become a successful investor. Remember, anybody can do this with the right knowledge, patience, and discipline. So don't let these myths hold you back. If you haven't started investing, start today. And if you are investing, stay away from as many of these as possible. If you like the video, don't forget to subscribe. I'll see you next week in a new video. Till then, keep learning and stay on top of your finances. Until next time.